Now is it ready? Okay, fine. Thank you very much. So what you basically, I think now it should be audible, and what we own basically is what we typically call it as an asset. What we owe basically is what we typically call it as a liability. And when we talk about a balance sheet, I specifically said it is always as on a particular date, on a specified date. Because why do we say that on a specified date out here? Because every day your position, financial position basically keeps changing. So when every day the position keeps changing, that is on, when I say it's on a day, it's basically at the end of that particular day. End of that particular day is what we call it typically as, what do you call it as a balance sheet, okay? So now we will take some examples. We will take some examples and run through it before we even move into the doubt spot of it out here. Whereas when we sort of move on further, what do you call it as a profit or loss statement in this particular case, what we call it as profit or loss statement or profit and loss statement. I think there were some people who asked the question, why should we call it profit or loss statement? Why should we call it profit and loss statement? It is basically profit and loss statement. That is what because it gives you the statement, what you call it as, gives you what is called as at the end of the day a profit or a loss that basically you finally arrive at. That is what we call, that is where we normally say that what is called it's a profit and loss statement. In the profit and loss statement, we look at only two aspects out here. We look at basically revenues. We look at expenditures out here. But the most important thing in this particular case is we look at revenues, we look at expenditures. But these revenues and expenditures should pertain to the specified time period. Specified time period for which you are basically what you call it as preparing, what do we say, this financial state, this profit or loss statement. It could be a time period of a month, year, etc., etc., etc. out there. So that is the core difference when we say between P&L and a balance sheet. Balance sheet is what you own and what you owe. This is basically between what do you call it as revenue and expenditure for the specified time period for which you are preparing the profit or loss statement out there. Now, moving further from here, I'm just doing a quick recap of what all we did. Let me repeat. I'm just doing a quick recap of what all we did so far. So now, if we are to move further than this, for example, normally the kind of questions that I have encountered, some of the doubts that I have encountered is, supposing I buy, what do you call it as, buy a car, for example. When I buy a car, why is it not treated as an expenditure in the P&L statement? That is a kind of a question which I have actually seen in the kind of doubts that have been asked. Please note, when you buy a car, please understand, the use of the car is going to be beyond this specified time period what you have basically indicated. Beyond this specified time period what you have basically indicated. So what happens? So is the entire expenditure pertaining to this specified time period? Basically no, because the benefit of this expenditure is way beyond this specified time period. So what do? We basically charge only that portion that is used in this particular specified time period. So that is what we call it as depreciation. That is what we typically call it as depreciation. When I say depreciation, what is depreciation? That is, depreciation is the value of that particular asset that has been utilized in this specified period out there. The rest of the asset, value of the asset is not utilized. You buy an automobile for, let us say, about 10 lakhs out there, use it in the first year, you feel that it is usable for a period of 10 years, you use it in the first year, then what happens? 1 lakh worth of that automobile you have already utilized out there. So remaining 9 lakh worth of that automobile is still, the value is still there and it is owned by you. That is where what happens is, that 9 lakhs worth of automobile will come and sit as basically your asset in this particular case. That 1 lakh worth of automobile that you have utilized will basically go as depreciation as an expenditure out here. I think I am clear in this particular explanation of why these things, these kind of expenditures basically do not, do not basically get treated in what you call it as an expenditure in the P&L statement. Am I clear? Is there any doubt? Pratik, is there any doubt? Anybody is coming up with any doubt? You please tell me. If nobody is coming in, we can just move ahead in the process of it. Yeah, that is fine. That is perfect class. Now, the third basic aspect, third basic statement, then we will take up some transactions also and try and see how these behave. And then we'll look at the doubts out here. We'll try and see, we'll take up some transactions. If you actually see this in this particular third statement, what we looked at in this particular case is what we call it as the cash flow statement. When we talk about the cash flow statement, we look at the cash flows under three broad heads out there. That is, please note, when we talked about in the earlier case, when we talked about revenues does not mean cash flows. Revenues does not mean cash flows at all. That is, revenue as what you call it as, I think I use this word, what you typically call it as accrued during this particular period. Accrued means it has accrued, but I have not received this money yet. It is accrued, I have not received. I might not have received. I wouldn't say, rather than saying I have not, I would say I might not have received this particular amount out there. So that is the difference. Whereas when we talk about the cash flow statement, we talk about the basically what you call it as, we basically call it as the flow of money. When we say flow of money, that is, we call it as inflow of money and what is called as outflow of money. We call it inflow of money and outflow of money. Now, when this only tracks about inflow and outflow of money, again, for a specified period. That is, during the year, during the what is called as whatever it is, during the time period, whatever money that has come in, whatever money that has gone out, irrespective of the purpose out here. Irrespective of the purpose. That is where basically what we talk about inflow and outflow out here. Please, you can ask me any doubts what you have so far in that particular course out here. This is basically a live session so that we can interact and then I can clarify any specific doubts what you have. Now, this particular, when we talk about what we call it as, when we talk about cash flow statement out here, we are looking at what are the aspects we are looking at. When we said inflow and outflow. But this inflow and outflow are also classified under three basic categories. That is, the first category what we classify is what is called as, we classify under what is called as operating cash flows out here. The second category I basically want to classify is what we call it as investing activity. The third basic category what we talk about is what we call it as financing activity leading to what is called as your cash flows out here. These are the three core activities under which basically your cash flows are what you call it as divided, or basically what you call it as the money that comes in and the money that goes out are basically divided. When we talk about operating, it pertains to any money received or paid with regard to your core operations, core activity. When supposing you are a manufacturing enterprise, any money that comes in or goes out because of what you call it as a manufacturing activity will all basically fall into this. Now, when I talk about financing activity out here, any money that is basically raised, money that is coming in as what is called as, for example, in the form of capital. When I say capital out here, I mean both equity, I mean also what is called as debt. Debt means any long-term borrowing, etc. Any of these, that is any money that is coming in or going out. Repayment of debt is a cash outflow because of a financing activity. That is money coming in or going out related to what is called as this capital, or what do you call it as servicing of this capital. When I say servicing of this capital out here, I mean to say, for example, you pay what is called as interest, you pay what is called as dividend, etc. All these aspects out here, servicing. When I say servicing of this capital out here, all these that is what we are trying to say. Your business itself is being financed. Your business is being funded by somebody. That is, the money that basically is being paid out or collected with regard to funding is all what we term it as basically what we call it as a financing cash flows out here. I think I am very clear on that. Now, the third basic aspect what we look at is what we call it as typically as in this particular case, I'm going to use a different color if I'm seeing, I'm going to use it, I'm going to see is basically what we call it as investing cash flows. Now, what do you mean by this investing cash flows out here? I'm going to write on this part of it, I'm going to write slightly out here. When I talk about investing cash flows out here, I specifically mean to say that wherever you are basically spending, that is where you are investing. You can invest in what is called as a fixed asset of the company. You can invest even in what is called as shares and securities of other companies out here. You can invest in what is called as, you can invest in basically what is called as, you can park the money for any short-term investments. All these aspects out here will basically what you call it as what all these aspects basically all the listed. When we say listed means if it is listed on any of the stock exchanges in the country, then it becomes what you call it as mandatory. That is, all the three statements becomes mandatory at the end of every financial year. I hope I have cleared it out what you basically have. Now, I sort of continue from where we are. I think can you just reduce the temperature of AC because it's too hot, too warm for me. Now, move on further. These are basically what we call it as the basically what we see is the three financial statements what we have basically seen out here. Now, I will look at what you call it as, let us keep the cash flow statement aside for the time being. We will take up one problem from the textbook. That is, I think most of you would have got this textbook by what you call it as Anthony and Hawkins. This is one of the older editions what I have. I think you guys might have one of the recent editions. You guys might have a recent edition. I have a slightly older edition out here. But that is okay. That is a textbook which we follow for what is called as basic accounting, and that was also indicated right in what you call it as, that was also indicated right in the outline. Now, the other doubt I have from Vaishnavi Khale is net worth part of cash flow. What is net worth? Net worth is the money that belongs to the shareholders. Now, where is it that value that belongs to shareholders? Now, where do we see that what is called as the value that belongs to shareholders? The value that we see that belongs to the shareholders, basically you will see only in what is called as your balance sheet out here. When we talk about what you call it as, when we talk about what you call it as, when we talk about balance sheet out here, we basically, no, don't move in this particular case. When we talk about balance sheet out here, we normally say liabilities plus basically when we, we're moving, no, I'm moving it, so don't worry, I'll take care of it. Now, it is basically what we call it as liability plus capital. When we say liabilities for capital out here, capital is the money that these people have contributed to the business out here. Let me just give you a brief about how does a balance sheet look like. It basically, a balance sheet will look like this kind of an aspect out here. Now we have what is called as equity capital. Then normally you would prefer to have what is called as reserves and surplus. What is reserves and surplus? Reserves and surplus is nothing but it is generally the money that basically belongs to the shareholders out there. What is the money belonging to the shareholder? All the money that is basically created out of the profits of the company. All the money that is basically created out of the profits of the company basically is what is called as your reserves. It could be in various forms out there. Now these two constitute what is called as net worth of the company. Beyond this, you have other liabilities. You might have a long-term liability, that is, which could be in the form of loans, etc., from the banks and financial institutions, etc. You could have other short-term loans out there. You could have current liabilities out there, and so on and so forth out here. Now, whereas when we look at the asset side part of it, you normally have what is called as fixed assets out there. The next you have what is called as investments out here. Third, what you have what is called as the current assets out there. And fourth, of course, as I told you, is basically miscellaneous expenditures and losses. I will explain about this also in a few minutes from now. Now, what are we trying to say? If I sell all these assets and generate the money what I have indicated in the balance sheet, pay off all these liabilities what I have indicated out here, what is the money left? The money left will be basically this particular amount out here. That is the equity plus what is called as your reserves and surplus totally, and that is what we basically call it. I basically call it as a net worth of the enterprise out there. I hope I have clarified this particular aspect. Okay. We move on further. When we talk about, in this particular case, I was talking about cash flows out here. If you have any other doubts, you can just keep asking and I can see, and then I can try and see if I can clarify also as we go along the process out here. Now, if we move further in this particular case out here, let me do one thing. Let me take a couple of transactions out there and try and see how most of these are basically getting affected, or what we did with an Excel. I'm not going to use an Excel. I'm just going to use a simple dashboard out here, and then I'm going to do it. Now I'll say, let us say we make a statement out here. The statement what I make, let me say that I'm making a statement saying that there is somebody who has contributed money into the business out there. That is in the form of capital. Now visualize what happens. That is, now the business is an independent entity. Now, as far as the business is concerned, the business will have to give the money back to the person who has contributed on the day you are basically winding up that business out there. So what is happening? Now that is something which is supposed to be given back out here, but not immediately, maybe at a later stage out there. So where will it sit? It basically will find a place in liability plus what is called as capital out there. That whatever money that is contributed, let us say it is equity capital out there. What is happening? The other side. There is cash that is owned by you. So what is it? It's basically an asset that basically is there with you, and the cash balance basically increases in the process out there. Now the next aspect I am sort of looking at using the cash, buying a fixed asset out there. I use the cash and buy a fixed asset. Then immediately what happens? My cash basically comes down out here, and my fixed assets on the asset side increases out there. Third statement, I buy a fixed asset using a mortgage. Using a, what do you call it as a mortgage? When I use a mortgage, and then what is the mortgage? Mortgage is basically a borrowing that I have had. Moment I have had a borrowing, then what happens? My liability, that is what you call it as, my liability basically enhances out there. Now what happens? You bought another fixed asset out there. Now what happens? The fixed asset again increases. Your liability, your asset out there. That is basically what is the kind of interactions that keep happening out there. Now, how does it affect when there is, what do you call it, as if there is what is called as an expenditure out there? Let us say I pay salaries. Let me look at what is called as a P&L statement out here. I pay salaries out here. I am talking about all revenues out here or income. I am talking about all expenditures out here in this particular case out here. Now, supposing I pay salaries to my employees out here. When you pay salaries to your employees out there, then what happens? There is an expenditure is increasing. If expenditure is increasing, what happens to your profit or a loss out there in this particular case? Basically the money, and there is no revenue in this particular case, so what happens? Whatever I make is basically a loss out there. This loss is to be borne by whom? This loss is to be borne by what is called as an equity provider, or their capital will basically come down to the extent of the loss that basically is incurred out there. When you pay the salary, your cash balance also comes down. Please note, your cash balance comes down on the asset side. To the same extent, what happens? Your capital also comes down to that same extent. Supposing there is no revenue, in this example what we took, there is revenue is zero. There is only one expenditure, that is salary. I have paid salary, that means my expenditure is more than the income. What I have incurred is basically a loss. Now, if I move further, what happens? When I paid salary, what has happened? My cash has basically come down in the process. So what happens to the loss? Loss is borne by whom? Borne by the equity provider, the capital. Capital is basically reducing in the process. So what happens? The extent to which your cash has gone out, your capital has reduced in the form of loss. So what happens? Your balance sheet will automatically get taken care of, or it will get balanced in the process out there. Am I communicating at this stage? If you still have any doubts, you can come back to me. I think this part is slightly. Let us take one more example. Supposing I say, I get, what do you call it as, I get something like a fee, what do you call it as a royalty fee. I get a royalty fee of about some X amount out here. And then I also see this expenditure out here, the salary expenditure is far less than the X. So whatever the profit or loss is basically nothing but X minus the salary expenditure. What I have is basically okay. Let us assume that it is a profit. Now what happens? Moment you have received a consulting fee, your cash balance has increased by the consulting or royalty fee. Cash balance has increased. But at the same time, you have paid some amount for salaries. So it has increased by the net amount. That net amount is what basically what you saw is the profit out here. That net amount, that is this income minus this expenditure, is the profit. Now what has the cash gone up? Cash has gone up by royalty, gone down by salaries. That is the net increase in cash is only the difference between these two. Now what happens in this particular case? I basically, whatever is the profit, that is the resultant figure, profit belongs to the equity holders. So what do I do? I add it to the equity capital. Your balance sheet basically gets balanced in the process out there. Yes, Govind, you can, any question you can ask me. I think I am clear about the P&L and balance sheet part of it. This is all what happens, especially in the P&L and balance sheet out here. Nothing beyond that. Do you have to wait for any question to appear? Anybody is on in line with any question? Nothing? Okay. Now let us do one thing. Let us take up, I think there has been, let me take up some of the questions that you have basically asked out there. I have just printed out most of these. I will write the question. Okay, I'll write the question also. I will sort of write the question also in the process out here. Now, I can go here. I will, sir. Now, I will go from the last question out here. Vaishnavi Sudhir, I think the question is, what is a cash flow? What is cash flow? Let me explain. Cash flow is nothing but the actual cash coming in to the business and actual cash going out of the business. When we say actual cash, we mean cash plus cash equivalents. When we say equivalent, we mean any amount that basically is there in the bank or anything which can be converted to cash easily. So cash flow, what is cash flow? Cash flow is nothing but actual money movement to and from the business. That is all what we call it as a typical cash flow. Okay, fine. Now I go to the second question out there. I want to clearly know what is bill of exchange. That is, what does he say? He says, I want to clearly know what is called as the bill of exchange out here. Let me just add one more page out here. What is bill of exchange? Let me change the color for the. What is bill of exchange? Bill of exchange, if you actually see this in this particular case, it is what we call it as a promissory note. You just take a currency note. When you take a currency note and actually see it, what does it say? The currency note says, if you have the currency note in your pocket, you can just pick it up and see. The currency note just says, I promise to pay the bearer that so and so amount, that is whatever is the currency note, depending on the kind of currency note what you have. It is basically nothing but bill of exchange is basically a promissory note. Now when does it happen? Now I imagine I buy what is called as goods out there on credit. I buy goods on credit. I don't pay the person, I am buying on credit. Because I buy on credit, I give that person a promissory note which indicates that I will pay so and so, from whom I am buying, the amount that is specified for the purchase of these goods and the date that is also specified for the particular thing. That is, I give him a promissory note saying that I will pay X amount for the purchase that I have made today on with the date that it is due. That is what is called as the bill of exchange. Now what is the use of this bill of exchange? This bill of exchange itself, if you actually see this bill of exchange itself can basically be what we call it as discounted. When I say discounted, what do you mean by discounted? Discounted means I can take this bill of exchange and then go to the bank. When I go to the bank and then I can discount, that is, supposing I say I have a bill of exchange where I am eligible to get the money on 1st of October. That is almost close to about 20 days from today or 20 days from today, etc. I need the money as of today. And the bill of exchange is for about 1 lakh rupees. I will go to the bank today and then the bank will take that as a guarantee. That is, they know that a 1 lakh is going to come to you on October 1st. Take that as a guarantee and give me some money out there. They will not give me 1 lakh. They will give me, say, supposing 95,000 or 96,000. That 4,000 less they are giving, that is basically for their financial cost. They are giving me the money today, but when are they going to get the money? They are going to get the money when the person pays on 1st of October. That is what we call it as discounting. I give the bill to the bank, get the money as of today, some money, little less than what is the money that is basically I am eligible to get on the bill out there. That is what we call it as discounting. Can you read? Can companies issue promissory notes in lieu of debts? Companies can issue promissory notes. But again, there should be takers for promissory notes, that is, can issue a promissory note, there should be takers for. As long as there are takers for promissory note, companies issue promissory notes and they do issue promissory notes also. That is what we call it when we talk about bill of exchange.
There is one more question.
Yeah.
Miscellaneous expense, is it included in net worth and reserves? Does reserves include miscellaneous?
No, where does miscellaneous expenditure and losses occur? If you actually see this balance sheet, what I drew out here, I think I drew a balance sheet somewhere out here in this particular case out here. I think let me just get that. Yeah. whatever I give. Where does miscellaneous expenditure and losses come out there? This entire thing out here, this entire thing, miscellaneous expenditure and losses is basically unamortized. The amount that is not utilized, that is you are still kept. What is miscellaneous? Let me take an example. Supposing you spend about 10 lakhs on an advertisement by getting a movie star, and you feel that the ad will have a life for 3 or 4 more years out there. 3 years out there. Now, at the first year, what part of the expenditure that you have spent on the ad, you are charging into P&L, only 1/3 of it, because the ad has a life of 3 years out there. The other 2 years expenditure amount, what you have basically spent out there, the amount that you have spent out there, it is already spent, but the benefit of that amount is not derived yet. So what happens? That will sit under the head miscellaneous expenditures and losses, and it's basically owned by you still. It's an asset out there. It could be even, for example, tomorrow you might sell the company. When you sell the company, the purchasing company can still use this ad out there. Possible. So it is basically part of an asset. It has nothing to do with your liability part of it. Am I with you on this? Now we move on to the third question out there. I am just going to skip one of the questions because which is out of the purview of this course, that is how to write a good research paper on classification shifting. Now, we are not talking about writing research papers out here because we are talking about what do you call it as the basics of accounting, basics of finances out here. Next question, how to take strategic decision in financial matters out there. Strategic decisions and financial matters has a lot of, again it's out of the purview of this particular course out here. It's a decision making, but what we do is we do basic decision making in terms of ratio analysis, etc. Strategic decision making will involve a lot of aspects out there. When I say a lot of aspects out there, it is basically we look at what you call it as the future cash flows and a whole lot of things. That is part of the next advanced course which possibly I will be teaching hopefully. The next doubt I have was from Mr. Prabodh. Which capital structure is good for a company? How to identify promoters as well as are promoters very well managing the capital as debt is cheaper than debt is cheaper than capital, etc. To be very, I will try and answer this question, certainly yes, but to be very precise, that is not what this course is intended to sort of talk to you about. If you actually see this, when we talk about what is called as capital structure decision, though that is not directly part of this course, capital structure is nothing but a combination of what you call it as equity and debt out there. You got to have some combination of this equity and debt, which is basically what do we call it as is the correct combination out there. Why do we need to get the correct combination? Please note, equity also has a cost, debt also has a cost. These costs will vary with the percentage of debt and equity in the business out there. Why does it vary? Give you one very simple example. Now, supposing I have a company and I have my profit before interest and tax as $20 out here. And I have a debt in the capital structure and I have what is called as the interest in the capital structure, interest because of the debt that I have my interest as about $4 out here. Then imagine $16 is profit before tax out there. Let me say tax at 50%. For ease of multiplication, I'm going to do it. And then tax goes as $8. This $8 is what you call it as profit after tax belonging to what is called as equity holders. Supposing the situation changes out here. I take more debt in the company. I change the capital structure. I need more money. I need to raise my capital, expand my business. When I need to expand my business, I take more debt in the capital out there. If I take more debt in the capital out there, if I take more debt out there, then what happens? Your cost of debt will, your debt payment will increase. That is, the interest payment will increase out there. Supposing, what will the interest payment? The interest payment, imagine, moves basically to $8 out there because you are doubling the debt out there. And imagine for the time being, the worst case scenario, you earn the same amount of profit because the moment you borrow, next day the money is not, what you call it, is your business is not going to grow. It is going to take some time. You're borrowing today, I'm going to put up a plant and then it's going to grow. So it's going to take some time. So imagine if, for it hypothetically, if the worst case scenario, if you try to earn the same amount of profit, then what happens? Basically, you get $12 out here, you pay a tax of $6, and then how much the equity holder gets? Equity holder gets $6 out there. So what happens? The risk of the equity holder keeps on increasing once debt in the business and the capital structure keeps on increasing out there. The risk for the equity holder keeps on. Why is the risk? Earlier case he got $8, now he's getting the $6 out there. Why? Because the debt holders earlier were getting 4, now you have doubled the debt and they are getting 8. They are not taking any cut out there. The risk for the equity holder keeps on increasing as capital structure keeps changing. So that is where what we normally say, there is a cost out there. Cost for debt, cost for equity. When we talk about capital structure, we look at such a combination where this particular cost of equity and debt is kept what is called as at the optimum. Now, how to decide what is the best capital structure for the company, etc. All that will get decided based on the company you are basically analyzing, and that we are not getting into it as of now because that is not part of this particular course out there. Okay, fine. Now, any doubts? Any other doubts, Pratik? Okay. Now I go on to the next couple of doubts out here. Now I have a doubt from one Mr. Kumar. He says, I have a doubt in 2 and 3 answer responses. Which one? Working capital loan from a bank is a cash flow from what activity? When I talk about loan that I am taking, basically what am I trying to do in this particular case out here? Let me go to a cash flow statement out there. Let me just go to a cash flow statement out here. Let me go to the cash flow. When I normally take up what is a working capital loan out there, when I take up what is called as, what am I doing? I am doing financing activity out there. That is, I am borrowing for what you call it as to take care of my what is called as financial needs, my capital needs out there in the business out there. When I am borrowing to take care of my capital needs in the business, in the entity out here, what am I trying to do? I am basically, there is a cash flow from what you call it as typically a financing activity. Some textbooks, let me make that very clear, some textbooks could possibly treat it as a cash flow because of an operating activity, because purely the money is getting used for operations, etc. But strictly if you look at it, it's working capital loan, it is a borrowing. Borrowing means it is, you might be using it for operations. Supposing you have a very high equity capital in the company, surplus equity capital in the company, then the question of borrowing itself does not arise in the process of it. The question of borrowing itself does not arise in the process of it. So in that particular case, what happens? If the question of borrowing itself does not arise in the process, then there may not be any working capital. Because of your capital structure changes, that is when you are looking at what you call it as borrowing out in this particular case. In this particular case. So that basically is what we call it as cash flow from what is called as financing activity out there.
There is a doubt. Dividend received from subsidiary company, which type of activity it is?
Yeah, I'll do that. Any problem with the video? It's fine? It's okay. That's fine. Now, I have one more doubt before I continue with these questions out here of Amit Kumar. Let me address that doubt. Dividend received from subsidiary company. What have you done in the subsidiary company? Why do you receive dividend? Because you have invested capital in the subsidiary company. When you have invested capital in the subsidiary company, what is activity it is? It is a cash flow from investing activity. When you receive dividend on that particular investment, what is it? It's a cash flow again from an investing activity alone in the process. Now, I move on further. I think, Mr. Namit, I have sort of explained, you have given a logic, and I've sort of explained it. Now let me move to the next question out here. Interest paid on debentures is dash activity, is again a financing, is basically a financing activity out here. You have said that it is an operating activity because what you call it as, because it is used as trading securities, etc., 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 etc. Now, debenture is a capital structure decision. Please understand that debenture is what you call it as a capital structure decision. When I talk about it's a capital structure decision out there, that is, your company might have equity, another company might have debentures. Some company may not even have any debentures, but have all equity. So what happens? That debenture itself is coming in purely because of what we call it as a finance, is basically because of a capital structure decision. Moment you talk about what you call it as a capital structure decision, it becomes part of my financing activity, and financing activity alone out there. Third question what you have asked out there, company has opted for stock repurchase. This will cost about some amount of INR, 100,000, 100 lakh INR, what you have given out there to the company. The cash flow is treated as cash flow from dash activity out here. But in this particular case, again, what are you trying to do out here? That is, company has opted for a stock repurchase out here. Company has opted for a stock repurchase. Now, when you are talking about a stock repurchase, you are basically not investing in your own company out there. So you are purchasing this particular all the money, all the stocks out there. So basically, what we are looking at, you are looking at more and more from the financing. That is, you are in this particular case, I borrow and then buy it. That basically will become part of my financing activity in this particular case. Now I have the last doubt. Any doubts?
Yes, sir. What is the nature of joint venture and co-venture account? Vaishnavi.
What is the nature of joint venture and co-venture account? Basically, joint ventures in the sense joint ventures. I don't understand in what context you are talking about, in accounting context or which context. I am not very clear about that. Maybe you can just ask her that and then I can clarify out here. Now the third question out here, what we see, the last question out here in the doubts what we see is, we consider stock of goods is non-quick asset and receivable is quick current asset. In actual practice, do we really find receivables from customers in the balance sheet of any good company? Many good companies do business on cash or advance basis. So sometimes customer advances are found. Secondly, stock can easily be sold out or at a saleable price, but debtors cannot be received equally. So how can it be a quick asset? Now, please note, can I have the sheet out here? Please, can you ensure that it is there? Thank you, sir. Now, if I sort of look at it, please understand there is a lot of difference between these two. Every good company will have what is called as you have said, no good company will have what is called, many good companies in business do on cash or advance basis. Please note, good companies will also have what is called as receivables. These receivables will be termed as what is called as, it could be what is called as debtors. It could be what is called as bills receivable. It could be accounts receivable. Today, no businesses are never done on cash basis out there. There are some very few businesses which basically get done on cash basis. Most of the businesses will always be on credit out there, and that will all have this particular component out there. If they do not have this particular component, what they do is they do what is called as discounting of all their receivables out there. Whatever money that they ought to receive, they are basically discounting it with the bank and then getting the cash. Every company will have what is called as receivables. Now, your argument, how can receivables not be a quick asset, whereas when I call it as inventory is a non-quick asset. That is what you have said, the current asset and is a non-quick asset. It is not easily convertible to cash. Let us take a very simple example, sir. Supposing you are looking at Maruti Udyog, that is the example which we use. When we take Maruti Udyog out here, there can be three kinds of stock out there. One would be raw material stock. Second would be work in process inventory. Third will basically be finished goods stock out there. Which is that which can be converted to cash very easily. If you actually see, at the most, maximum finished goods can be converted to cash easily. Now you say that stock can be sold at a saleable price. Supposing I am inventory of a lot of car shells out there. That is the lot of shell of the car out there. When I say shell of the car, I have what is called as the basic structure of the car, but without the engine. How will you be able to sell it? Will you be able to sell it? It is impossible for you to sell it. I am talking about any stage. For example, or I have an engine, I have tires out there, I have the shell which is unpainted. The car is not still gone to the paint shop out there. It is still in the body shop. Now, will I be able to sell it? So, when I talk about inventory, especially when I talk about work in process inventory, number one, it is never saleable out there. It is selling that work in process unless the job on it is completed is just not possible. Number one. Number two, when I took out the next aspect out here, I take is what we call it as raw material. Even raw material inventory. In the sense, it is not easy for you to liquidate raw material inventory. Let us take a very simple example. Maruti Udyog buys tires from MRF, Goodyear, Apollo, etc. for their cars out there. Now, MRF, Apollo, Goodyear are basically in the tire sales business out there. They will have their distributor, they will have their retailers, and then they will keep selling out there. Perfectly alright. Now, if Maruti Udyog suddenly says, I have a lot of inventory, I want to sell the tires out there to get money. You don't have, your distributors are not basically going to sell the tires out there. You got to look at establishing another set of distributors for the tires out there. That is basically a challenge for you. So liquidating this particular kind of a asset out there, what you call it as the inventory out there, becomes a real challenge. So what happens? That is where we normally say, we say that inventory is always basically what we call it as is a sticky asset out there in the process, whether it is work in process inventory or whether it is finished goods inventory. They are all what is called as sticky process out there. Sticky process means the ease of conversion to cash is not possible. Whereas, can I collect money from debtors? That is also equally difficult. I am not saying that it is possible, but you have one advantage. The advantage what you have is I can go ahead and discount all these receivables what I have. I think I have clarified almost all the doubts out there. Pratik, we have done it?
Yes,
we have done this.
11.5 there is a request here as well as we had an
we have clarified almost all the doubts out here. Now I go to what is called as exercise in cash flow statement. That is what we call it as in this particular accounting textbook what I have. The chapter number 11, which is on cash flow, I am looking at what is called as solving this problem 11.5. That is where I think most of you have had a doubt on problem number 11.5. We will spend some time on 11.5 and then we will basically try and see if we can close the class out there for today. Am I ready? Yeah, I think you can just get it organized out there because I need to sort of look at it. Now, if you look at in this particular case, if I sort of look at the problem number 11.5 out here, if I sort of look at the problem number 11.5 out here, let me just open a new sheet in the process. The problem number 11.6 says, the owner of a small business, I don't know if you have a textbook with you, please open chapter 11, exercise number 11.5. I think we are going to do that. It says that the owner of a small business has asked you to prepare a statement that will show him where his firm's cash came from and how it was used during the year. He gives the following information based on a general ledger out there. There are a couple of aspects what they have mentioned out here. One, he says collection of accounts receivable, interest on savings account, sale of old machine, cash sales, and then so on and so forth out there, and then a list of entries which are basically called your adjustments out there. Now, can we look at, in this particular case, they talk about direct, indirect, etc., etc. Can we look at what is the operating cash flows? What is the operating cash flows out here? Operating cash flows out here pertains basically to the core operations out there. Now let us look at, first let us look at the positives out there. The statement says sales were to the extent of 61,410 for the year. They also say that collection from accounts receivable was to the extent of 34,300 was there, and then cash sales to the extent of 27,600 was there. So basically that is what we call it as money, or what you call, I would say, cash flow, cash inflow on what do you call it as sales out here. Total sales, that is on total sales will be nothing but 34,500 plus what do you call it as money, that is on cash sales out there, that is 27,600 out there. Now I have not touched upon the sales figure at all. Even if you can actually look at it, you can actually get the sales figure. Sales figure is it's about 61,410 out there. The next statement, it says accounts receivable decreased by 690. Now what is the total of this? Let me put out the total of this out here, 0 and 0, and then what do you call it as 1, and then 5 and 7 is 12, and then 3 and 2 plus 1 is about basically 6 out there. Now, am I right with the total? Pratik, you keep checking. Now the next thing, basically let us go the other way around. What was sales during the year? The sales during the year was 61,410 out here. Now, what are the receivables last year? What are the receivables last year? The receivables last year, that is basically whatever is the amount out there, I don't know, the collection from receivables. Receivables out there, this year collection, there is what is called, this year receivables is down by 690. What are the receivables last year? Receivables last year was basically 34,500 was basically the receivables last year. Now, this year what is the receivable? This year receivables is down by 690. This is basically receivables last year. The current year receivables is, it is down by 690. That means you have received for about 33,910, if I am not wrong. Am I 34,500 minus 690? How much is it, Pratik? Yeah. 33810. Sorry, 33810. It is 33810. Now current year's receivables is 33810. That means what have I received? What is the money? 810. I have corrected it. Sorry, I have corrected it. It will take 30 seconds to sort of show up there. Yeah. Now, basically, if you actually see this, what happens in this particular case out here? This is last year. This is the current year receivables. Now, let us see this. This is the money total sales. This is the money that you have received on the last year's, what do you call it as sales. This is the money that you have to receive on this particular sale of this year. So on the sale of this year, this is the money you have to receive. So basically, what is the cash received on this year's sales? This minus this. That is 61,410 minus 33,810 out there. How much is it, sir? 61,410 minus 33,810. 27,600 is basically what money that you have, basically that is the cash sale out there. Then on this, what happens? Last year's money I have basically, which I have received, is indicated. That is what gets you my 62,400. That is basically what we call it as typically your cash receipts out there. Now, operating part of it. Now the next aspect out here, in this particular case out here, what is the cash outflow because of operations? Cash outflow because of operations is all the payment that you have made to vendors out there. That is, if I say cash outflow on operations, on cash outflow on operations, the money that you have basically payment to vendors out there, the money that you have paid to vendors, that is 17,250 plus cash purchases and supplies, that is 345 plus cash purchase of what you call it as inventory, that is another 17,250 out there. Basically, what happens? These three put together will basically constitute what you call it as cash outflow because of what you call it as ops activity, in addition to what do you call it as rent that is basically paid. What is the rent that is basically paid out there? 8625. What are the utilities that you have paid? 2070. What is the interest payment will not? What is the miscellaneous expenditure in this particular case? Miscellaneous expenditure in this particular case, what we call it as, is 1725. I'm sorry, I think 1725. Plus, what do you call it as? What is the next aspect out here? There is a part-time help out there, 6,900 out there. There is nothing due on any of these things out here. So if you actually see this, it says that it instead of all this, to putting all this together, if you read the point number 3 itself, it says cash operating expenditures total 54,165, which included cost of sale, supplies, rent, utility, part-time help, and other miscellaneous expenditure out here. Can I go to the big screen out here? All these put together, he says, is cash outflow in this particular case is 54,165 out there. 54,165. This account payable increase, decrease, let us not even worry about all that out here. This basically is the cash outflow. So what is the net operating cash flows out here? If I look at what is called as the net operating cash flow out here, if I will say net, if I say out here operating inflow is basically 60. What is the amount we calculated, Pratik? Out here 62,100. Outflow, we had what we call it as, we had is about 54,165. So what is the basic difference between this inflow and outflow? 7935 is the cash flow from operations. Am I right? I think it's fine. Now let us look at the other basic aspects out there. The other aspect is basically investing aspect. Investing. The first and foremost, interest on savings account 345. It is basically that because you have kept the money invested the money in a savings account, there is a cash inflow from what is called as savings account, savings interest out here, that is about 345. Next, when I talk about investing out there, sale of an old machine 3,105. You have invested in a machine, you have sold the machine today, that is cash inflow from sale of a machine out there. If I say that is about 3,105. That is also basically positive cash flow that is basically coming out there. Next, if I look at in the expenditure part of it, there is what is called as down payment for a new truck 3,440. That is when you make a down payment, there is cash outflow for down payment of a truck out there 3,450. I am putting it in bracket, parenthesis. Parenthesis means negative out there because there is a cash outflow. Now what is the resultant figure out here? 345 plus 3105, 345 plus 3105 minus 3450. It basically resultant figure cash inflow or outflow from what do you call it as an investing activity is nothing but zero blob out there. That is cash inflow from an investing activity is zero. Now let's go to the last aspect out here. Now what do you call it as? Typically financing activity. Any questions, sir? What is the question?
What about account payable changes in that year?
Okay, now Prabhu, I'll come back to it in a minute because exactly like the way we did it for the receivables, we'll do it. Don't worry, we'll just come back to it. That is where we'll come back to it in a couple of minutes out there. Now I'm talking about financing. Once we finish financing, we'll come to that. When we talk about financing cash flows out there, Where is it? There is a sale of old machine is over, there is cash sale collection from receivable, interest and savings account, sale of old machine is all over out here. When I am looking at what you call it as financing cash flows, there is a repayment of debt out there. There is what is a cash outflow on payment of what is called as debt out there. What is the amount out there? The payment of debt is about 3,450 negative payment is there. That is, payment is basically made out there. Now, if I look at the cash flow statement out here, what are the cash flow statement? What are the basically, we will say cash flow from operations, investing, financing. Now, let us look at adding these numbers out there. 7935, basically it is 7935. Investing is 0. This is 3450 negative. So, what is the cash flows out there? 4,489 is the cash flows. 85 is it? Okay, I'm sorry. 85. Now, to this, I add the cash that is at the beginning of the year. The first item on the in this problem out there, the cash at the beginning of the year, that is nothing but 3450 is the cash that, because you start with the money. You start with the money in your pocket out there. Now, what is that? What is the cash that you ought to have out there is about 1 for 8 plus 1 9 and then 4 plus 3 7,935 should be the cash that is there at the end of the year. At the end of the year out there. Am I going wrong somewhere? Yes, I am going wrong somewhere. There is cash at the end of the year is 6,900. Now, question is, where have you missed it? Let us sort of look at it in the process out there. If you actually see this in this particular case out here, if you actually see this, there is somewhere basically you have missed out here. Now, what is that basic aspect we have missed out? Let us sort of see this in this particular case out here. If you actually go back out here in this particular case out in this particular case out there, if you will basically see the cash that is there at the end of the year to be about 6,000. Now, basically, if you add these two, you ought to get what is called as the cash that is at the end of the year, and you got the cash that is there at the end of the year. You got to get is about 6,900. Now, there is a mistake in one of the places where basically I think I have. One of the basic aspects out here. Where is it? Can you, one of you, identify and tell me? No, I'm okay. We'll sort of, we are going by this. Perfectly all right. If you actually see this inflows out here, inflows are perfectly all right, 6,100. If you look at the outflows per se on this particular thing, 54,165. Any problem with it? Now, if you look at these outflows per se, you actually look at these outflows out here. What are we looking at in this particular case? Outflows, cash, that is, we should cash operating expenditure totaled 54,165, which included cost of sale, that is cost of sale we have taken, supplies, rent, utilities, part-time help and other miscellaneous expenditure in the process. Now, somebody also asked me about account payable decreased by about 2760 in the process out here. Accounts payable decreased by about 2760 in the process out here. Let us look at that particular aspect out here in this particular case. If you look at it, what was the, what do you call it as, what is the cash supplies out here? The cash, I had done this also in another sheet out here, yeah, I had done this. What are the cash supplies out here? The cash supplies out here is basically 345 was the cash supply, cash purchase of supplies. Cash purchase of inventory was 17,250 out there in the process. Now, these two out there. Now, the third basic aspect is payment to vendors out there is about 17,250 out there in the process out there. Now, if you actually see this, what is the basic cash part? What is the basic cash that has gone? 17,250 is basically what is called as payment that has happened to the vendors out there. Now, cash receivables, the accounts receivable decreased by 600. The accounts payables decreased by about 2,760 out here, out in the during the year out there. That means what has happened? in the next particular year, the difference is, Pratik, can you just do this? 17,250 minus 2,760.
14,400.
Basically, what happens in the current year, your receivables is only about 14,490 is what is there in the current year receivables out here. This is the previous year what you have received out there. Now, if you actually see this in this particular case, cash purchase of inventory, cash purchase of supplies, etc. out there, basically what has happened? You have basically made payment to the vendor account. You have made this payment out there, plus you have made what is called as, 17,250 out here, plus you have made a cash purchase of this inventory out here. Let us say cash purchase of this inventory you have basically made out there. Then you basically have what is called as a cash purchase of suppliers. You basically have 345. You basically have. In addition to that, what happens? Your accounts payable has gone down by so much. That means you have bought additional material out there. That is the difference between these two. Also, basically you have paid. That means another 2,760 is basically what has been paid in the process out there. In the process in the basic process out there. So basically, if you actually look at this particular, what is the total payment that has basically gone on in the process out here? That is the total payment that you have made is this 17,250 plus 345 plus this 17,250 is basically what you have. Can you just do this 17,250 plus 17,250 plus 345? Plus 2760, that is basically the difference out there, and then all the other aspects out there. 6900. I'm sorry, I think I took the wrong number out here. That is where we went wrong. Yeah, 6900 part-time help, 8625, 2070, 1725.
Sir, minus 690.
Yeah, well, minus 6900. Plus 8625 plus 2070 plus 1725. Huh? I didn't get you. 1725
Plus 2070.
plus 1725. The whole thing put together, this entire thing, if you look at this entire thing put together, if you actually, you can either do it, calculate it that way also. You can either club the whole thing in this particular case out here, or like calculate it like this. That is what they have said. That's 54,165 is basically what basically they have got in the process out there. Any questions on this? Yeah.
43.
Now wait, you have to get, basically you look at this entire payment out there. That is the entire total payment in this particular case, like what you did for this inflows also. Can you just calculate it in the process? Yeah. Whatever is the complete payments, you can take the book and basically do the calculation and then give me the numbers, because I don't have a calculator here for me to do it. Yeah, fine, perfect, all right.
This totaling is not correct in the book, I think.
No, book is fine. I think you are missing out somewhere.
62,100 minus 70.
No, you are missing out somewhere. You just give it to me. I'll handle it in the process. Okay. Now, yeah. If you actually see this, basically what we are trying to say in this particular case out here, We look at, I think we have done some, maybe one of these totaling errors out there. I'll ask him to put up the solution again in the process out here, That is basically what we have looked at. In this particular case, we looked at four operations out there. Have I missed out anything on the operations? That is what is my worry is. I think I might have missed out. I'm just trying to check that again in the process. Anyway, let's leave that again. Let's leave that aside. If we basically look at in this particular case out there. So what are we looking at in this particular 62,100? That part is fine. Then when we look at the outflows out here, outflows is nothing but outflows is clearly all these are listed out here. 17,250 plus 345 plus 17,250. And then what do you call it as these are the three, and then your rent payment is 8625, and then your utilities is 2070. And then and then now I got it. What we left out is we left out what is called as, there is something called as what we typically say is there is an interest payment that is there out here. There is what is called as an interest payment out there. We covered that interest payment. Interest payment is something which we have left out. Interest payment happens basically in financing out there. So when there is that is what I was wondering out here. I'm just going to erase this part of it, and now I know where we have missed out in the process out here. Now there is this is the cash outflow. Then there is what is called as the next is interest payment. Interest payment is also a cash outflow. And why do you pay interest? You pay interest because of financing activity 1035 out here. So now what is the total? 3450 minus plus 1035. 4485 is basically what you have as a cash or as the cash outflow because of financing activity. Now we'll come back. We'll go to operating. What did we arrive at operating out here? We arrived at operating cash flow as 7935 out here. I arrived at cash flow as 7935. I arrived at what is called as investing cash flow as blob. I arrive at financing cash flow as what is called as negative 4485 out here. So, and then what is the total cash flows I have? 7935 minus 4485. I have what is called as 3450 out here. Then I have my opening cash balance out here. My opening cash balance is another 3450 out there. That gives me what is called as 6900, which you can verify with what is called as my closing cash balance out there. I'm sorry, I had missed out. That is what I felt that I had missed out. So I had missed out. Now we get it. What we call it as? We call it as the closing cash flows out here. I am just going to color it out here. The closing cash flows in this particular case out here. We basically see this closing cash balance, that is 6,900 what we have out here. Now, let me go back to the question what you had asked me. Sir, why didn't we consider what we call it as in this particular case, what happened to this 3,000, what happened to this, whatever was there in this accounts payable, etc. No, go back. The amount that is given as 54,165 is after considering all that out there. Or else you can even total it. If you even total it, how do you total? I will say 17,250 is what I have paid to vendors out there. 345 is what basically I have purchased out there. Then another 17,250 is what I have made a cash purchase out there. 8625 is what I have given as a rent out there. Then I have 2070 is what I have paid as utilities out there. And then I have what is called as other miscellaneous expenditure of 1725 I have given out there. And then I have what is called as part-time help. I have paid 6,900 out there. If you can total all these basic aspects out here, then basically you will almost arrive at the same kind of a figure out there. Can you total it? 17,250 17,250 plus 345 plus 17,250 plus 8625 plus 2070 plus 1725 yeah, correct, perfect, plus 6,900. we got basically what is the amount we got? We got 54,165. What is the amount that is given out there? 54,165. We are not considering this accounts payable because that is already taken care of in the numbers what they have basically given out there. I hope I am clear. Is there anything
Yes,
that
one question.
yeah?
Can you give example of operating, investing, and financing activities by VGP Dinesh?
Yeah, operating activity. I purchase raw materials, buy cash for my production. I sell goods and then collect cash. That is again operating cash flow. I collect cash and receivables. I pay cash and payables, all operating. Investing. I purchase a fixed asset. That is, I am investing in the fixed asset. I invest in a short-term deposit. Investing. I am earning interest on the money that I have invested. Finance, basically investing. That is cash inflow because of investing. I can investing in a subsidiary equity shares, cash outflow because of investing. I get dividend on the equity shares, what I have invested, cash inflow because of investing. Financing cash flows. When we look at financing, somebody invests in my company in equity shares, I am getting cash inflow because of financing. Somebody, I borrow money from the bank, cash inflow because of financing. I pay dividends to my shareholders, cash outflow because of financing. I pay interest on the borrowing, cash outflow because of what is called as financing out there. Any other question, Pratik?
No, sir.
I think with this we almost complete basically whatever we have. I think we will have one more week of classes where I am doing the ratio analysis. I think we can go ahead with the ratio analysis out there. Okay, I think with this we will sort of wind up today's session. Thank you very much. Thank you. Can call Ravi and close it. Close. Today is closed, we can close it. சரி நாளைக்கு ரெக்கார்டிங் இங்கே வந்துடலாமா?